What are the major economic developments that you should be most concerned about right now without scaring the audience too much? And we'll talk about that with our next guest, Laurence Kotlikoff. He is a renowned professor of economics at Boston University. Laurence and I will be discussing not just the economy, but also the most important geopolitical events around the world, including the war in Ukraine, whether or not this will escalate to beyond control, and whether or not we will see a hot war with China. Laurence is the author of Money Magic, An Economist's Secrets to More Money, Less Risk, and a Better Life. He is a PhD economics graduate from Harvard University, and The Economist has ranked him as one of the world's 25 most influential economists. Welcome to the show, Laurence. Pleasure to have you on Kitco.
Thanks for having me, David. Great to be with you.
Honored to have you, Laurence. And I like to break down the interview into I don't want to say two parts, but I want to just talk about two primary components of the economy. First, as it relates to investors and capital markets, and the other as it relates to the everyday person. Of course, there are, overlaps, but let's start with talking about what's on everybody's mind, whether or not you're an investor or just an average layperson living in America. Mortgage rates have spiked up unless you've bought your home with all cash, and unless you have a fixed rate. This probably does affect you significantly. The 30-year mortgage rate has spiked up to more than 6%, up from 3% just the beginning of the year. Does this rate of growth concern you at all, Laurence?
Well, clearly the housing market is being affected. Housing sales have dropped. And in terms of cash flows, having to pay 6% versus 3% is tough if your salary hasn't gone up commensurately. So you might be hesitant to buy a house because of that. On the other hand, we have to realize that the reason the mortgage rates have gone up is that we're running 6, 7, 8% inflation. The most recent data suggests a 6% annual increase in core inflation, or maybe even 7% in core inflation over the coming year, because the most recent monthly numbers were suggested, I think, a 0.6% increase in prices, a half percentage point increase in prices over the month of August. August. So we're running a high inflation, and this means that even though the mortgage rate is high, the real mortgage rate, after you subtract inflation, is actually low, if not negative. So at least in the short term, if you took out let's say a 30-year mortgage and you're paying 6.5%, if inflation ends up being 8% for the year, you're paying negative 1.5% after inflation. In other words, you're paying back in watered down dollars. So I realize that people, don't have the cash to come up and cover this, would be hesitant to buy. But others who do have the cash to buy a home, they want to buy a home, they may be held off by high mortgage rates, but they should really understand that the real mortgage rate, which is what they should really focus on, is actually quite low, if not negative, and some ways lower than it's been for most of the post-war, so that buying a home with a mortgage can actually be cheaper right today than people think. Now, if the mortgage rate stays up, if you go into a home with a 30-year 6.5% mortgage, and inflation comes down, now your real mortgage payment is going to be going up. But at that point, you can refinance because mortgage rates would likely come down, long-term 30-year mortgage rates. Or you can also buy, invest in a shorting, and you can take a mortgage that's floating, that those rates are lower. So I think people need to think more carefully about what these mortgage rates are telling us if they're thinking about buying homes.
The one thing that people are wondering, and maybe an economist of your stature could shed some light as to how high the mortgage rate can go from here. As you'll recall, the mortgage rate has been higher in prior years, much higher prior to 2008, in fact. And so this 6% that we're seeing is not unprecedented. The question is, when will it stop?
Well, if the inflation rate went up to 20%, mortgage rates would probably, go up pretty close to 20%. But the real mortgage rate could actually go down That's what the real mortgage rate is the mortgage rate minus the inflation rate. So if the inflation rate exceeds the mortgage rate, we're talking about a negative real mortgage rate. So you get to pay back, with a 20% inflation, you're paying back in very watered down dollars. You owe this fixed payment, and then prices are rising by 20% every year. So the fixed payment today corresponds to a certain number of hot dogs. Next year corresponds to a much smaller number of hot dogs. So you're paying back in fewer hot dogs through time. Is another way to think about this. So I think we should keep an eye on the real mortgage rate, not the nominal mortgage rate. That's what people should be thinking about. This is where having an economist on your show is some value added, because we think about things. We don't get emotional about the actual level. We're saying, of inflation or interest rates. We're thinking about the differential.
Mm-hmm. Is there a relationship, historically speaking, between the real mortgage rate, which is the inflation-adjusted mortgage rate, and home prices? The Case-Shiller Home Price Index has been peaking. I say peaking because it's the growth rate has plateaued, but it hasn't really declined to, I guess, let's take pre-2020 levels, for example. So people are worried about a decline in the housing market, but we haven't really seen a crash yet.
Yeah, I think that house prices could crash. They could continue, could plateau for a while. They could start going back up, because they are a good, safe way to hedge yourself against inflation, because they're a real asset. So buying a home is getting something tangible.
Yes.
But I want to point out, David, that if you have a house, suppose you already own a house, David, and the house price drops, and you intend to live in that house. It's your dream house. You're going to live there for the next 50 years. And so what's happened to you if your house price drops in half? Nothing whatsoever, because the services from your home, like I'm sitting in a room in our house, the services from having this room continue. It's not affected at all from the fact that the house prices around the corner, or this house price, has dropped or goes up, because the stream of services stays the same. So here again, if I had to sell this house today and move to, let's say, San Francisco, where house prices haven't fallen, if they have fallen here, then I'm going to be hurt. But if I'm going to be staying in this home, the stream of services will not change. So most people who are homeowners are not impacted whatsoever by house prices dropping or rising. But people don't see that. So they get kind of psyched out about housing. If they see the house prices are falling, they may decide now's not a time to buy, or not a time to sell, because they can wait to sell at a higher price if they are trying to sell. And some people who have homes might feel poorer, even though if they look around the house, nothing has changed,
Well, yes, but I have, Laurence, just on that point, very important you brought that up. You feel poor. I have read academic research that shows that in the past, a decline in home prices has led to a commensurate decline in aggregate spending from consumers, because people feel poorer on paper. Is this something that you've observed?
Yeah, I think the psychology here, it was what I'm trying to get to indirectly in answering you. Psychology matters a whole lot, because people aren't economists. They're not trained to think the way I've been trained to think. So they get things wrong. And they also listen to what other people are saying, and other people are focused on the wrong things as well. They're saying, oh, mortgage rates are high, but nobody's saying in the same conversation at the drugstore, oh, but inflation's even higher, gone up even more, and real mortgage rates have gone down. That's not a conversation that's taking place. People say, well, housing prices are dropping. Woe is me, woe is us. Nobody says, well, anything changed with your house? Did it fall apart? Did you sleep in the same room last night? Anything really changed with your life financially? No, they don't.
Right.
So people are misperceiving what's actually the economic reality. And then even if I get it straight, David, that things are not so bad, let's say I'm an employer and I have a lot of workers, and I think that you don't understand that things aren't so bad. You think things are really bad because the press is writing about it, that we're going to go into recession or something. So I think you're scared, and I think you're going to fire your workers because you're scared. Your workers are my customers. So I start firing my workers because at the end of the month, if your customers don't show up, I can't pay my workers. So I fire them, and they are your customers. So this can be self-fulfilling prophecy. Expectations. We both believe something that's not true, and then we make it happen through our actions. So that's why if you go to kotlikoff.net, if your listeners, viewers go there, that's my main website.
Linked in the description down below, but yes.
Yeah. There's an article that posted under articles called The Big Con. It talks about the Great Recession in 2008. It points out that all the explanations for the Great Recession that were given by the Financial Crisis Inquiry Commission, the formal government commission, was directed to say what caused the Great Recession and how can we keep it from happening. They said, here's the 10 things that caused the Great Recession. You look, 12 years later at the data, none of the things they said caused the Great Recession actually are supported by the data. Indeed, almost everything they said was true about things in 2008 are not true in terms of the actual, for example, the subprimes that were supposed to cause the recession, the crappy liar loans and no-doc loans and ninja loans, they turned out to perform much, much better than people expected. And the worst of the worst ones were the ones that the Treasury bought up when they got Bear Stearns JP Morgan to buy up Bear Stearns. Mm-hmm. When Bear Stearns went down in, I think it was March 2008. And they bought up $31 billion of the worst of Bear Stearns as subprimes, because otherwise JP Morgan would not buy Bear Stearns stock at $2 a share when it was like $180 a share a couple of months before. The whole thing. So the Fed buys this stuff, holds on to it. It's called the Maiden Lane Fund. Maiden Lane is the street behind the New York Fed. It's basically saying this is the rear end of the New York Fed. This is excrement that we bought. That was the nickname in effect. Maiden Lane Fund, $31 billion. At the end of the Great Recession, a couple of years later, they sell this fund for more money than they bought by. They make a profit on it. That's an example of how we got things wrong. So I wrote this article called The Big Con because there was this book and movie called The Big Short, right?
Right.
Which suggested all this stuff was true. And The Big Short was a big con. And I'm not, somebody who's like a Pollyanna about this stuff. If the data has supported the idea that, so what I'm saying is that the Great Recession was our conning ourselves into thinking we're having a Great Recession, that we had all these problems that didn't actually exist. That's where the psychology comes in. We psyched ourselves out as a country, and we put ourselves into recession. We talked ourselves into recession. And we've been trying to do that now for many months in this country and around other countries around the world. We may succeed in talking ourselves into a Great Recession, into another recession. Just one last thing. The Great Recession actually wasn't so great. We only had a 3% drop in output in 1981 to 82. That was another recession. We never called it great, but the decline in output and the increase in unemployment was almost identical. We didn't call that great. Why were we calling this thing great? We called it great before it was great. It was never great.
Okay, let's talk about
an illustration of the fact that we're psyching ourselves out.
So this is a self-fulfilling prophecy that we're talking ourselves into a recession by,
Could be.
I guess, not spending as much. What about the supply side?
Well, we have seen, the Fed has gotten itself convinced that it needs to raise rates dramatically. But what's really going on with inflation, I think, is supply side, is the fact that we've had COVID, the Putin war in Ukraine, raising energy prices, grain prices also. We've had disruptions in Chinese production. So all these things have led to, in many cases, temporary price increases. And now we've gotten inflation underway and people are expecting it. So it's kind of locked into people's expectations. So firms we have like 35 million businesses in this country. They're setting the prices, not Jerome Powell. And they're saying, well, I look out here, I see prices going up. I got to raise my workers' wages. I got to therefore raise my prices. And then this thing keeps happening because everybody sees reports. So we have to have the Fed chairman and the president say, do some jawboning, like John Kennedy did with the steel companies when he took office, and say, look, we need to lower, you guys are setting the prices. I don't set the prices. Jerome Powell, there's for 35 million of you. Let's have you keep a lid on the prices. And yes, try and help your workers to the extent you can, take a lower profit for a while, but let's get everybody collectively on a page of raising prices at a lower level. Because a lot of what we're doing here is each of us raising prices because we think other people are raising prices, and raising wages because we think other people. So let's collectively change the psychology and coordinate on a lower level of inflation. And also, let's not coordinate on recession. Let's coordinate on growth, because if we all believe in a recession, we're all going to make it happen. The Fed, have only one little tool, the interest rate I can set. And by the way, I tried to use it. We tried to use it in the Great Recession, and it didn't work much. It didn't keep us from having a pretty deep recession and a 10% unemployment rate. We kept lowering the interest rate, didn't work. Now we're raising the interest rate to try and stop inflation. It may put us into recession, but it may not stop inflation. If these 35 million companies keep raising prices, what can I do? I think he needs to talk turkey with the American public and change their mindset. And he's the guy to do it because he's the Fed chairman, or the Treasury Secretary, Janet Yellen. She's one of the top economists in the country. She's brilliant.
How do policymakers convince the public to, in your words, stop raising prices on each other without implementing price or wage controls?
Well, they can just start talking about, this is a patriotic thing to do, because it's going to help the whole country, and ultimately it will help you if we all do this together.
This reminds me of the prisoner's dilemma, a classic game theory case where, if we're all better off if we take a bit of a loss, but I don't want to be that guy that thinks I'm not raising prices and somebody else is going to beat me to it, right?
Yeah, on the other hand, keeping your price lower than the competition may lead to more customers. So it's not
True.
that dangerous a move. But you're absolutely right. There is game theory here. There's what's in collective interest versus personal interest. It's very much a part of what's going on. As I said, you got your employees are my customers. Mm-hmm. Even though I know it's not in our joint interest for me to be firing my guys, I'm going to fire my guys because I think you're firing your guys. That is the prisoner's dilemma in a nutshell. Okay,
so to sum up, and then we'll move on to other topics. You don't think this coming recession is going to be as severe as people are making it out to be? Are you sincerely thinking that, or are you just saying that to alleviate some of the stress, and then we'll create a loop to not be so worried and actually help the economy?
Since I think we have the capacity to, I think recessions are generally psychological more than economic.
It's a very interesting point. Yeah.
Then I can't say for sure. The last big one we had, 2008. We psyched ourselves out. There's no support for it in terms of what people said caused it.
Objectively speaking, though, Laurence, the unemployment rate rather, did spike up in 2008. It wasn't to a level that was unprecedented in history. If you look back at the unemployment rate chart, which I'll put up on the screen, we had actually higher levels of unemployment in 1981 than in 2008. And this year, we're still at 3.7%. I'm looking at the latest data point.
So I don't think we're in I agree, David. I don't think we're in recession now. I don't think we've been really in recession for the last 6 months or since February, because unemployment is still very low. We have the share of people working is at almost a post-war time, which that's the employment to population ratio. So if you look at the facts, if you look at the facts, there's no evidence of recession, but yet everybody in the newspaper is writing about recessions and the media.
Yes.
Why are they doing this? Well, bad news sells,
Yes.
and if somebody else, other news organizations were talking about a recession, I have to talk about it. I got to talk about it 24/7 because I have nothing else to talk about. So could we be heading to, can I say, because it's psychological that
Right.
that it won't happen? No, I'm saying it could very well happen.
Right.
President Roosevelt said, I think, the most interesting set of words about macroeconomics. He said, the only fear to fear is fear itself. He said that in 1933, uh, when the day he took office, I think, or a week later, as president. He said, the only fear to fear is fear itself. He's saying that there's a psychological uh, element to the Great Depression. But if you think about that sentence, it says that, hey, fear is something to fear.
What
And,
about
if we have enough fear, we will have a recession in this country.
what about the 2 quarters of consecutive real GDP decline that we've had? Does that constitute a recession per definition?
I don't really think so because it didn't, I think recession's more about people out of work.
Okay.
And you have companies that didn't accumulate as much in inventories over this period because for whatever reason they decided to. So that counts as a decline in output because I didn't buy as many, lamps to sell to customers. So I'm holding a smaller inventory. Maybe I was worried about the future, so I didn't order as much and not as many were produced. I think that's like third order. In general, recessions are not, if you look at the history of GDP in the US, there's small blips or somewhat bigger blips on a general trend that's been positive in terms of output. So I think we make too big a deal of recessions in general that,
Right.
we certainly don't want to leave, if 10% of people are unemployed, that's a problem. That's not too much. That's a big deal. But
Correct.
we shouldn't kind of get too pessimistic about the future because uh, the idea that we're going to get into a Great Depression again for 10 years, it's extremely unlikely. The Fed just won't let that happen.
Okay, that was my next question. Whether or not the Fed would let that happen, there is speculation that if they continue to raise interest rates, that a severe recession, I've heard, could come. No one's actually told me exactly at what level the interest rate would have to be for a severe recession to be triggered. I guess no one really knows. But the theory is that if they continue both monetary tightening and quantitative tightening, the tapering of their Fed assets, the economy will inevitably slump into negative growth. What would you say to that?
I'd have to say is we need to look at the real interest rate the Fed is setting or trying to set, not the nominal interest rate. If inflation is 20% and the Fed raises interest rates from its federal funds rate from basically 25 basis points to 5 basis points, and the inflation rate is 20%, we're talking about a negative 15% real federal funds rate. So the real short-term rates that the Fed has helped, because it doesn't have full control, achieve in our country are still extremely low, if not negative. So the Fed, as far as I can tell, sounds like it's fighting inflation, sounds like it's threatening to put the economy in recession, but is actually just accommodating the inflation. It hasn't taken steps like Volcker let the federal funds rate go up from some low number to about 20% overnight. And by the way, David, he didn't actually do anything to make that happen. He just said he was not going to do anything to keep it from happening. And the markets immediately moved the rate like that. You don't see that happening today. Jerome Powell, I think, is accommodating inflation, but he's being goaded by people like Larry Summers, the former Treasury Secretary, also a former friend and colleague of mine, and co-author of mine, to raise rates. And I don't know what Larry's game plan is here, whether this is personal or whether he really believes this, but putting the economy into recession in order to keep prices from rising and wages from rising. Well, I think what we should do is fix our tax system and fix other things so that if inflation is high for a while, everybody can live with it. We don't want to put people out of work, kill the economy when we can accommodate the temporary inflation. So I think Powell's being goaded into raising rates beyond what maybe should happen here.
So what is your outlook on inflation? You've said two very important things that I can recall. The first, what you just said, is that Powell is being goaded to raise rates, but ultimately it's not enough. It's not Volcker-esque enough. But you also said earlier in the interview that a lot of the inflationary pressures we've seen was due to supply chain issues in the Putin war in Ukraine. So suppose that side, the supply chain, fixes itself, would it not stand to reason that the Federal Reserve does not have to raise interest rates more in order for inflation to come back down naturally? How would you respond to that?
Yeah, I think most studies think that 2/3 of the price increases are supply chain or supply disruption related. And we've seen, think about the price of oil. The price of oil today is lower than it was, unless I haven't looked in the last couple of weeks, but as of a couple of weeks ago, was lower than it was at the beginning of the invasion of Ukraine. So there was a big supply side shock. Russian oil kind of comes off the market. Russian gas comes off the market, and or the concern that it will come off the market comes into being. But then other suppliers like United States has increased its supply massively of energy products, fossil fuel products. So that's happened globally. So there's been a big supply side response. So the price of oil per barrel has dropped below from where it was back in February. The price of grain, everybody talked about how grain prices were going to be dramatically higher because Ukraine is one of the biggest suppliers. Well, Ukraine is the 8th largest supplier of wheat. That's not the biggest supplier, it's the 8th largest. The US just has to increase its wheat planting by a small percentage to deal with the loss of the Ukrainian market supply. And wheat prices today are lower than they were back in February. So there has been a supply side response, and will continue in all these sectors. Restaurants prices have gone, meals have gone way up, and that's because a lot of restaurants, 70,000 restaurants closed. So there's less competition. But more restaurants will open. They are opening, and they'll force via competition those prices back down.
Let me just ask you more directly then, Laurence. Jerome Powell has publicly stated that his goal is, and he is committed to this goal, his goal is to bring inflation back down to 2%. Is that a realistic number in the foreseeable future?
Well, I think the goal of getting it down to 2%, if he's saying, I'm going to get it down to 2% in a year, that's crazy. And he's not really saying that. He's saying, I'm going to get it down to 2% at some point. That's like cheap talk. I mean, that's saying nothing, really. That's saying, to me, I'm going to try and accommodate this inflation. I'm not going to do anything radically stupid. I'm going to be goaded to a certain extent so I can keep my job. But I'm not going to go full Larry Summers and kill the economy. Volcker had a different approach. His approach was, a lot of people praise Volcker, but they're not the ones who lost their job back in 1981. And Paul Volcker was a lovely person, very, a big, tall statesman. I knew him personally.
Okay, yeah. I was just going to ask you if you knew him personally. Okay.
I knew him, yeah. He debated. I met with him. We had in his office, and we debated each other in public. But did he do the right thing? I'm not so sure. I don't think so.
Do you know Powell personally?
I never met Powell, no.
Okay, so Volcker, you think did the right thing, but okay. So I want to come back to the capital markets now. In 2018, we were talking offline. The Federal Reserve intervened to boost the capital markets by pivoting. You'll recall that they did raise interest rates initially, and actually to a greater extent than what we've seen so far. But then we had a taper tantrum in 2018. The S&P 500 went down something like 30%, and then they pivoted shortly afterward. Powell has demonstrated that he does care about, at least on paper, he does care about where the capital markets are going and how investors are responding. What do you think he is going to do now? We've already seen a 20% decline in the S&P 500, a roughly 20% year to date. And that's not counting other assets like cryptocurrencies that have been wiped out. So far, no signs of a pivot. In fact, hawkishness is the theme of the Federal Reserve right now.
Yeah, but if you look at their actions rather than their words, he's not done. He hasn't raised the federal funds rate above the recent inflation rate. Inflation is still running above the federal funds rate, so significantly above. So he's still maintaining a really low real rate. So I don't see him. I think he'll respond, but try and keep in a very measured way, and make sure he doesn't totally psych out the economy. I think that's his temperament, and I think that's the right thing for him to do. But I think his language, he's upping his language to accommodate people like the press and people like Summers and the Congress and the concern. But that can be dangerous. It can psych everybody out. So I think he needs to talk more deeply about this self-fulfilling expectations and coordination, and why inflation is not as big a problem as recession, and why we need to have the Congress adjust the tax system so we're not taxing phantom capital gains or phantom interest income. And we have to protect people that are on fixed pensions, like retired policemen in Detroit.
Yeah.
That's the kind of thing we need to do. We need to live with inflation, but talk it down, and not. Yeah, he can kill the economy, but he doesn't have the Fed. He showed during COVID that he's prepared to take huge measures to keep, assets. As you said, stock market dropped about 34%. I think it was in March 2020, and then he comes in and starts buying up corporate bonds and other, all kinds of securities at high prices, low rates, in effect, giving implicit subsidies to corporations. Now people looking at them say, oh, gee, this company used to have to pay this interest rate. Now it's paying a lower rate. That company's worth more on its debts. Therefore, I'm going to buy it. He pushed the stock market right back up through his intervention.
Yeah.